on, I would like to invite our platinum sponsor, TransUnion, represented by Jeannine and Nudia Falyun, to present the keynote address. Jeannine is the General Counsel for TransUnion Africa. She oversees legal, risk compliance, and governance functions across 8 countries in Africa. Prior to this role, she served as the Credit Bureau Association Managing Executive and has also worked in the telco, banking, and retail sector. She has extensive financial services background and experience in driving financial inclusion while ensuring compliance. She holds legal and business qualifications, including a Master of Business Administration, and is actively involved in various industry bodies, including serving as the chair of ASISA. Please join me in welcoming Jeannine to the stage.
Thank you. Good morning. So for those of you that study the product handbook closely, you will realize that I'm not Dries Zitzman. I am, as Talita has introduced me, Jeannine from TransUnion. And it really is very exciting for me to be here today. I've seen so many familiar faces, people that I've grown up with in the industry. Over the last few days, we've had a number of very engaging conversations with regulators, with some of the bureaus in the space. And today is really exciting. I'm excited to kick off today in terms of bringing this a little bit closer to home from an industry perspective. So what we've decided to do is to maybe start the day linking all of these various conversations that we've had over the past few days by bringing the consumer into the picture as sort of the person that sits at the center of the ecosystem when we talk about policy, regulation, access to credit, financial products. And I'm going to be sharing today with you a research piece that we do on a quarterly basis that looks at consumer sentiment and specifically what drives consumers' decisions around certain choices that they make around how they conduct their finances and how they show up in the markets. Let's check that this pointer is working. There we go. So what I'm going to be covering specifically is I'm going to give you an overview of financial health. So we spoke, for those of you that missed Lee's presentation yesterday, he dealt in detail with some of the drivers that support consumer empowerment and actually sustain financial health. So we're going to be delving a little bit into what that looks like from a consumer perspective. We're going to look around perceptions around credit inclusion. So for instance, what people feel they've got access to, whether they feel that the products that they have access to actually caters for their needs. And then also, given the growing demand in the market around digitization, if we look at the Kenyan market as a contrast to the South African market specifically, we see that in different segments, there's definitely an increased focus on digitization, frictionless onboarding of consumers, and easy engagement with the credit ecosystem. So we're also going to be touching a little bit on fraud to see what consumer sentiments are around fraud. So for the purposes of this study, because we've got as sponsors CIS Kenya and SACRA in the room today, we decided what we're going to do is actually spotlight Kenya and South Africa as 2 contrasting countries in terms of consumer sentiment. So as I've mentioned, we do both empirical and qualitative analysis around consumers every quarter. The numbers that I'm going to be sharing with you today and the story that I'm going to be telling is specifically around numbers as at the end of quarter 2. So we do refresh these on a quarterly basis. These reports are available on TransUnion's website. So you can, if this is interesting to you, you can go and have a look. I'll share the links at the end of the presentation. And if there's any further questions or information that you need, you're welcome to reach out to any one of the team that is here today. So sort of looking at financial health, one of the first things we ask ourselves is whether we see consumers actually improving. And if you look at the stats for both South Africa and Kenya, it's interesting to see that although marginal, there is an improvement in consumer sentiment around household income. In South Africa, this change has been very slight, and for those that come from the South African market, you'll know that consumers have been hugely under pressure from interest rates. We've seen a lot of pressure on fuel, food basket, load shedding is starting to improve, but also a lot of pressure on consumers from the job market perspective. So we're seeing unemployment increasing, and even people who are becoming despondent in terms of actually entering the job market. So the South African market's still slightly depressed. From a Kenya perspective, we see consumers as at the end of Q2 being much more optimistic. With a larger increase there. And when we look at what consumers are actually listing as reasons for being more optimistic about their household income increasing, it is interestingly the increased job opportunities in Kenya as at Q2, and then also people citing that they're starting a new business as an additional income stream. So this then sort of leads us into the next question to say, well, is there a correlation between this uptick from a consumer perspective, and is this actually driving an improvement in financial health? And here again, the numbers are interesting. South Africa is still remaining more depressed than Kenya, but by and large, if you look at the total sample of the population that we've assessed, still an increase with 85% of the consumers in Kenya indicating that they've deemed their household income or expect their household income to actually increase in the next 12 months. If we then move on and delving into this data a little bit deeper, we start looking at consumers' ability to actually service their debt. So if you are now expecting that you're going to have a larger household income, well, how does this sort of feed into your thinking patterns around debt, what type of credit you take on, and whether you think you will be able to continue to service this debt? And here, what is interesting about this metric is, despite the fact that we've done a lot of work in the South African market around rehabilitation, consumer education, trying to support the consumer through various mechanisms, as Mahata and some of the other speakers have touched on in the last few days, we're still seeing a very small increase in the South African market. In the Kenyan market, however, this is looking much more optimistic, and consumers definitely are indicating that they are more confident around their ability to continue to service this debt. So if you then look at paying debt off or servicing your debt, we then start to ask ourselves, what are consumers actually prioritizing? So if they now have this larger sort of share of wallet, they are focusing on paying off debt, what are they prioritizing and deprioritizing in terms of their choices? And here what is very interesting, we spoke yesterday also about consumers deleveraging. And consumers shopping across the line, we are definitely seeing that consumers are starting to make smarter choices around their debt. So definitely an uptick in putting more money towards servicing debt. And then also we see this sort of building this emergency fund or the slush fund nest egg for your family. And that really sort of speaks to the decision making that consumers are currently applying in terms of where they actually, like what they're actually consuming. So whether they're actually spending money on consumables, products, retail clothing, or whether they're actually putting that stash of money away to build this emergency or slush fund. So this is a very, very busy slide, but and I won't talk through all of the detail because it is hard for your eye to follow, but it just sort of supports the narrative on the previous slide in terms of where money is going. So in this instance, you see that almost 40% of South Africans and close on 50% of Kenyans are putting more money towards retirement and investment, which is a very positive sign in terms of how consumers also rehabilitate themselves. Okay, we then ask ourselves the counter question to say, if consumers are putting more money towards these things, what are they actually pulling back on? So what are they deprioritizing in terms of the choices that they're making? And here we see a definite decline in subscriptions and memberships. Now this is also interesting because if you look at this drive around digitization and how easy it is to actually consume some of these services on your phone, it does speak to the fact that consumers are paying more attention to what they're actually paying for. They are starting to question the value that they get out of these subscriptions and digital memberships. And if we get a little bit lower down in the presentation, we touch on fraud, I think that there's also an element there in terms of people starting to get anxious around what the information what personal information is actually being shared through these applications. And they're being much more conscientious around the choices that they make in terms of subscriptions and digital memberships. This sort of then brings us into the field of financial inclusion. And we've spoken at length over the last few days around financial inclusion, what we think the key drivers are for financial inclusion. I think there's no one in this room that is not excited or passionate about taking this forward. And we've highlighted a number of key things that we think is important for us as independent economies, but also as an African continent to actually drive this narrative. And what's very interesting is the perspectives we've heard over the last few days around some of the sentiment that consumers have this view around biases, reasons why they've been excluded or declined access to the market, versus the other side of the lens, which means if we can see you better, if we have better visibility, we can actually give you greater access. And I think as we move forward through these discussions, looking at the regulatory frameworks and things that support this, we're definitely going to be having more of these conversations around how we balance this consumer protection with access and making sure that we've got the right frameworks around it. So delving into financial, this topic specifically, Lee mentioned in his presentation yesterday, and I think on Monday when he opened the conference, that the average age of the South African is now 18.8 years. We are the youngest and fastest growing economy, and the African consumer is going to be the consumer of the future. The questions we need to ask ourselves is, do we understand what this consumer looks like? Do we know what this consumer actually wants to consume, what their needs are? And can we actually sort of adjust ourselves to make sure that we cater for this consumer in an appropriate way? So what's interesting for us to see is that it's very clear that the demand for credit is definitely coming from Gen Z and millennials. And if you've been tracking these numbers for a while, what's interesting is also to see as the millennials and Gen Zs mature, their appetite for credit is actually changing. So even within that band, it's not just to say if you're Gen Z or a millennial, you've got a certain behavioral pattern. We've even seen over the last few years that within that band, as they're aging in their respective bands, their appetite for certain products are starting to change, which is really, really interesting. This is also quite a busy slide, but what we've done is we've now actually cut the data into 3 lenses, just to give you a slightly different perspective as to what these consumers are actually looking at. So we spoke a little bit about the generational appetite. So I'm not going to delve into that. Yesterday, we touched a lot around credit scoring and consumer empowerment tools, and how actually understanding your credit report, understanding what makes up your credit basket, actually enables and empowers you to make better decisions. And what's interesting about that middle graph is if you look at it, you can see, specifically for Kenya, that appetite to take up credit across all of the credit risk score bands are actually quite high. So it's not that the appetite for credit only sits in a specific band. Irrespective of where you sit in the scoring band, that appetite remains consistent. If we then look on the right-hand side, sort of by rank order to say, like, what are people actually looking to take up? So from a credit perspective, what products are people interested in? You can definitely see that there's a shift towards personal loans, BNPL products, which is not equally taken up in all of the markets. I think it's still a maturing product in some of the markets that we operate in. And also refinancing of debt. And bringing it back to the conversation about deleveraging, even though a personal loan is a very expensive credit product, we see consumers leaning towards that because they are definitely feeling that they've got more flexibility around applying the personal loan for various different things, as opposed to just being boxed for furniture or clothing, retail, or a specific need. So it's quite interesting to see that there is this appetite for credit, yet people are still leaning to some of the more expensive and probably at this stage, some of the more accessible credit products. So despite the demand for credit, what we're also noticing is that in some instances there's not great follow-through in terms of consumers actually taking up the credit. And as TransUnion, I'm sure as some of the credit providers in the room, a lot of our conversations actually go about what this onboarding process looks like. So how do we continuously balance this seamless, frictionless process for a consumer against all of the external competing demands? So whether that is your credits, your credit appetite, whether that is your ability to actually manage fraud and make sure that you can actually onboard a consumer in a safe and responsible manner, and whether that is to do with consumer education around how the consumer is actually equipped to take up the loan product. I think those are continuous conversations that we work through. But here also, you can see, interestingly, in South Africa, almost half of the applications are actually abandoned. And in Kenya, as high as 66%, which is actually quite a high abandonment rate, not only just in terms of frustration, I think, from a consumer perspective, but also ultimately, I think, feeding into the cost of credit. Because for each of these applications, there's a process that sits on the back end, and the same level of diligence needs to be followed for a transaction that actually gets fulfilled versus a transaction that gets abandoned halfway through the process. And not sort of calling it out by rank order, but if you look at some of the reasons why consumers are actually abandoning these processes, you'll see what is quite interesting is that one of the things they definitely call out is the cost of credit. So consumers are becoming more aware, and I think Tupang spoke about it. Well, I can't remember, I've been here so many days now, I think yesterday, she touched on the cost of credit. So consumers are becoming more savvy around what it's actually costing them to take up certain products, but they're also looking, to the point I just made, around the seamlessness and the effort it actually takes to complete an application. So if you look a little bit lower down the graph, there's definitely some indications that consumers are actually abandoning the process because it's simply too frustrating or too difficult to go through the process, which sort of does bring the question back to us, says, as industry, how do we collaborate and actually make this easier for the consumer? This sort of then tallies very nicely into the consumer empowerment conversation. I'm not going to delve into this with a lot of detail. Lee spoke about it extensively yesterday in terms of the credit monitoring tools, and some of the things that we found really is a key driver in improving consumer empowerment. But maybe just a few things to call out. So if you're looking at this increased sentiment, you're looking at consumers' appetite to take up certain products, you do want to also understand what is, how do consumers actually feel about bringing in alternative data to give them better visibility to optimize their credit score. So this slide specifically, sorry, let me backtrack a little bit. I'm getting ahead of myself. We spoke yesterday also about the frequency and the and consumers' ability to actually to track and monitor the reports. Magata spoke about it a little bit earlier, identifying herself as a manager of credit. We spoke about the seekers and then the improvers. But what is interesting about this slide is if you look at the top three bars is the bulk of the consumers have actually recognized that there is a need to monitor their credit on a daily, weekly, or monthly basis. And in South Africa, we see a very high proponent of consumers actually signing up for monthly monitoring. Now, this is an interesting stat, I think, that came up in the presentations yesterday. I think since I've been in the industry, one of the biggest questions we've asked ourselves is why we can't drive this, this consumer appetite to actually take up your free credit report. And even though that number, the numbers that were quoted yesterday, are quoted as being optimistic numbers, given I think we quoted the numbers being at 17% of consumers monitoring their credit, this is still quite low for us. And this does bring back the conversation to say, do we need to look at other mechanisms to actually make this capability available to consumers? We have a number of partnerships with some of our partners in the room where through credit provider portals, tools, applications, they are starting to make these consumer education tools available to the consumers. A number of the bureaus already have these tools. But again, I think it comes back to the point that and someone made it the day before yesterday, I think it was the person from the Bankers Association, to say that this is not something that can be done in isolation. This is something that we as an industry jointly need to pull together on, and that we jointly need to push forward. Okay, so now dealing into just how consumers are viewing their credit, this monitoring and how this actually impacts credit scores. So if you look at sort of a transactional level and you look at consumer sentiment, you look at all of this education and empowerment, access to certain tools that we're giving consumers, we need to ask ourselves whether we think that there's an increase or a decrease in our ability to actually improve credit scores through these transactions. And here also you can see, if you look at the bars on the right-hand side, that 60% of Kenyans see an increase in this particular segment, and more than 51% of South Africans feel optimistic that this is actually a key driver to improving your credit score. Okay, this sort of then brings us to the tail end of the conversation, which sort of touches on fraud and identity protection. And this really is something I think that's not, or this isn't something that's on the agenda of any party in the room. I think it's a constant question we ask ourselves. It's a constant journey that we're on in terms of trying to evolve our posture in terms of identity protection. I think there's a lot of consumer education that's been done around identity protection. And it's something that we need to get our heads around to stay ahead of some of these industry trends that we see. So we ask ourselves then to say, if consumers have this sort of awareness of identity theft and protecting their identity, what are their sentiments around actually sharing their personal information? And what the research shows that's actually really interesting is that up to 72% of consumers in Kenya actually indicated that despite the fact that they know that they've been targeted by a fraudulent scam, they've not fallen victim to the scam. In South Africa, that number is slightly lower, and again, I think it's got a lot to do with digitization and just the channels through which you engage. But it is comforting to actually understand that consumers are becoming more aware around identity theft and identity protection. If we then sort of look at the next slide, we sort of ask ourselves what consumers' sentiments are around sharing their personal information, and whether they're becoming more or less concerned around sharing information. So what we're seeing is that we're not seeing that consumers don't want to share their information. What we are seeing is that consumers are more cautious and they're more concerned about sharing their personal information. And I think this tallies in very, very nicely with a lot of the efforts and the focus that's been putting in terms of creating this frictionless but secure onboarding mechanism for consumers. I think also and I know that there's some sessions tomorrow about cross-border data transfer and bringing in some of the privacy regulations into the sessions, but I think also as a continent we have a lot of nascent privacy regimes, and one of the challenges for us in terms of being truly African is also going to be to figure out how we give, and I think Marina will also talk on this in her presentation a little bit later, is how we create more transportability in a safe and secure mechanism for the consumer in terms of their data and giving them access not just in a particular market where they're operating, but also across the various markets where they might be migrating. Okay, so in summary, then just some key takeaways in terms of the research is we can definitely see that consumers are more optimistic. I think this is a good thing for us. We saw yesterday in the media that there's forecasted GDP improvement, which could lead to interest rate cuts in South Africa, which should give some relief for South African consumers as well. In the Kenyan market, we know that there's been some instability at the end of Q2. So as we continue to track these numbers through Q3 and Q4, we'll see how that flows through in terms of consumer sentiment, because it is important to just remind you that this is purely based on consumer sentiment. But we'll see how that flows through into the numbers. But by and large, there is a slight improvement and there is optimism from a consumer perspective. We're also seeing that there is still increased appetite for credit products. As I've mentioned earlier, it is going to force us to be more strategic, to be closer to the consumer, to understand what the need for credit actually looks like, whether these products actually continue to cater for the different segments of credit consumers. And then, closing out just in terms of some of the key takeaways around fraud, I think, which we've touched on. So I'm going to pause there. I know Talita said that there might be an opportunity for some questions. I'm not sure if there are any questions. Everybody's completely overwhelmed. Thank you. So for that, I thank you. I wish you a great conference for the next 2 days. It certainly is been very enjoyable for us for the first 3 days. We look forward to spending the next 2 days with you, and we're very excited to be part of some of these discussions that will be coming out of this conference. Thanks, Steve.